There is a secular trend in Bitcoin where Bitcoin is going from being an illegitimate asset to a legitimate asset. Things like BlackRock recommending a small allocation to Bitcoin as part of their model portfolio for everyone. Things like, Besant saying in a recent interview with Tucker Carlson that, lots of things are a store of value. Gold is a store of value. Bitcoin is becoming a store of value. This is actually evidence that the actual wake of the ship is turning.
All right. Welcome to the Bitcoin Policy Hour, a weekly podcast hosted by the Bitcoin Policy Institute, where we explore the critical intersection of Bitcoin and U.S. public policy. I'm your host, Zack Cohen, an associate with the Bitcoin Policy Institute, and I'm joined each week by my colleagues Matthew Pines, BPI's executive director, and Zack Shapiro, BPI's head of policy. A little quick plug here: if you enjoy our conversation, highly encourage you to learn more about our 2025 Bitcoin Policy Summit by visiting btcpolicysummit.org. Both Matt and Zack will be speaking at the event, amongst other thought leaders and government officials. All right, this week we're going to be digging into the tariffs, the topic du jour. So, Pines, can you take us away here? What are we looking at as far as the Trump admin politics going on here with the tariffs?
Yeah, I would sort of separate out the very concept that tariffs would be imposed by the Trump administration shouldn't be a surprise. I mean, this has been probably among the most consistent political positions of Trump of his life. So I think that was sort of baked in as a policy vector for the new administration. There was a huge amount of speculation, though, as to sort of the nature and scope of the tariffs. And my understanding is essentially there had been a sort of a factional competition playing out over the past few weeks leading up to Liberation Day as to sort of different ways of implementing the sort of tariff vision. Sort of the Besant camp wanted to approach a kind of forward guidance approach to tariffs, which essentially was laying down a track where tariffs would be incrementally and automatically sort of revised upward almost on a month-to-month basis, but would be sort of geopolitically tiered. So they had a vision of kind of three different sort of tiers of countries, kind of red, yellow, green, depending on their geopolitical alignment. And then there would be kind of a staged increase of tariff pressure on different geopolitical kind of blocks to kind of re-architect and reorient kind of the global economic trading system. So that was kind of the technocratic, kind of calibrated Besant faction approach to it. And then there was kind of this larger melange of kind of Navarro/Letnick, basically going hard in the paint. Like, let's sort of punch everyone in the face. Let's send a strong message. Let's kind of rip the Band-Aid off. No half measures, kind of, all in. And that seems to be the approach that won out with Trump and what we saw last week. I think the markets, however, that had been getting sort of softened up by Besant and sort of folks in the more traditional finance circles that Besant swims in, I think were being prepared more for a deliberative approach. And so they were surprised when sort of the Letnick, sort of faceplant came through. And so that was a lot of shock that the markets had to radically reprice since last week. And everyone now has been sort of recalibrating their models of what they think this will mean going forward. How much of this is a negotiation? How much of this is essentially as a first move, kind of like, hit everyone in the face and then say, let's have a talk. My understanding is that because of the virulence of the market reaction since Liberation Day, Besant was able to kind of regain the upper hand inside the White House. He went to Mar-a-Lago on Sunday night, and then was able to spend time with Trump and kind of basically convince him that this sort of rhetoric out of the White House needed to shift from a, this is it, deal with it, to a let's make a deal. And let's start talking about the deals that we're going to be negotiating. And so that's been the pivot I've noticed in the last 24 hours has been one of, we're going to start counting up the number of phone calls we have with foreign governments that are now coming to the table that are willing to kind of work out a deal. And of course, Japan, I think, is first out the gates. I know Japan is critical to the U.S. kind of geoeconomic monetary system. Besant has a very strong relationship with the Japanese. So that is kind of priority number one, I think, from their perspective, is to try to work out an arrangement with the Japanese as like a test case. And then I think separately, the next is is with Europe. Try to figure out, okay, is there a modus vivendi they can come to with Europe? I think Europe is treating it with some openness. The big kahuna, of course, is China, right? That's really what ultimately this all centers on, is the U.S.-China trade, economic, and strategic relationship. And there, however, I haven't seen any indications of a softening, right? If not the opposite, where everyone, we seem to be in a bit of a tit for tat rhetorically, that's now potentially going to lead to a dramatic rise, maybe 54% in tariffs on China now, and then a threatening of another increase, maybe as soon as today, depending on when this airs. Sort of changes by the hour. And so the China-US piece of this is the most dynamic and the most unstable, in the sense of the tit-for-tat dynamics could quickly escalate. China started to let their currency weaken past kind of the 7.2 band. I think it's 7.3 now. I haven't checked, but it's weakening sort of as a signal. And the last point I'll make before I kind of keep going on this sort of macro trade rant is one thing that I think has spooked the White House and policymakers and some market participants is the effect of all this uncertainty has had on the long end of the U.S. Sort of bond market, where you had an initial drop of yields in the 10-year as a result of kind of people pricing in recession and kind of overall market declines, but then you quickly had kind of a pretty radical repricing up of the long end, which kind of took away the entire benefit. And Bessent has pretty much said publicly and told his boss that like his job performance is essentially the 10-year yield. And so that, if you just use that one measure, it's not going so well. And so you had, whatever, 20% declines in the S&P, and only like a, 20 basis point drop in the 10-year. So not like a great return if that was the objective here. So, we're in this moment of like acute uncertainty. I think the markets are trading on kind of the first derivative of policy uncertainty. And I think that first derivative has reached like a local maximum. And so that maybe explain kind of this sort of relief bounce. But again, we're kind of going a bit tactical and sort of under the hood in terms of the market dynamics. I think though we're in a different regime now, where large macroeconomic shifts are underway that are policy driven, that are driven by a pretty firm ideological view of the White House. The way it gets implemented is obviously devil's in the details. You can have visceral disagreements inside the policy machine there. But I think the direction of travel is one where they want to rewire the global trading system. They want to restructure the balance of trade, and the way they see this is like an acute strategic vulnerability of the U.S. that we have been running these twin deficits for too long. Our defense industrial base has been atrophied. Our U.S. political economy has been sort of distorted. You have a lot of inequality, a lot of job loss, especially by the MAGA sort of political constituency, and that this administration is really committed to changing that. And we need to take our medicine, quote unquote, as Donald Trump says. So I have no market forecast. I wouldn't trade based off of my views, but I don't think that they're just going to like flip on their trade approach to change the system here. So I'll let Zack weigh in unless there's a thread you want to pull on any of that.
Zack, let's dig into the sort of Treasury bit here, and the Treasury bonds. So what's going to move those, in your opinion?
Well, before we get there, I think Matt's right to point out that this sort of key operative principle here is uncertainty, and where Treasury yields are most important is we've moved from the uncertainty about how tariffs are at least going to be initially implemented to what is the end goal here, right? Like what is the actual policy that is going to lead to changes in the global economy or an off-ramp from the current tariffs. And I think there are sort of, as there were with implementation, there are sort of two paths that could be at play here. One is sort of the more strategic, Mar-a-Lago Accord version of these tariffs, which is the way Bessent often talks about the tariffs, where this is a sort of strategic, either short-term or medium-term negotiating position to strategically onshore certain types of manufacturing and economy, maybe to refinance the United States debt, which would take, lowering Treasury yields. and perhaps also getting interest rates down from the Fed, and doing that all in sort of a slow, controlled, lockstep way, and then creating this sort of U.S.-based zone of free trade and having these sort of concentric circles of what we consider the U.S. sphere of trade. The other version of this is the sort of more simplistic, Donald Trump, we're getting killed on trade deficit version of this, right? Where there's been a lot of reporting that the percentage tariffs are just simply a function of the trade deficit between the United States and the country that's now being tariffed, divided by 2. And if the goal here is really we need to reverse all of these trade deficits that the United States has long term, I think that will have different and more powerful consequences for the global economy. First, these things are not going to reverse anytime soon, especially if you look at poorer countries. Some of the countries in Africa, we're tariffing countries like Vietnam that are trade partners of ours. These are very poor countries, right? And as a lot of economic commentators have said over the last few days, if you're a person in Vietnam, there are basically no goods or services you can afford to buy from the United States, where the minimum wage is something like $15 an hour, right? It's not going to work that way, and no amount of tariffs on their goods and services that are allow cheap goods and services for Americans is going to fix that trade imbalance. So if that is the metric that we need to end or change this, it's going to be a long and painful journey, and maybe we do onshore a lot of the manufacturing that these poor countries have with automation. But that's probably going to take a bunch of different industrial policy from the United States, and that's not going to be over anytime soon. And it's a longer time horizon than the sort of Besant Mar-a-Lago Accord version of this. The other long-term consequence, if we're going with a more hardcore Trump vision, is about a concept or sort of a set of concepts that Bitcoiners are probably quite familiar with: the exorbitant privilege of having the world reserve currency, and then Triffin's dilemma. For those not familiar, the idea is that there are some trade-offs of having the world's reserve currency, right? Everyone prices things in dollars around the world because it's the most stable fiat currency, and people hold U.S. treasuries as a reserve asset for their central banks around the world. The upside of this for the United States is the concept of exorbitant privilege. It means that we get to essentially print pieces of paper that people really need, because if you're in a foreign country and you're pricing your debt in dollars, you eventually need dollars to settle that debt, right? You're sort of structurally short dollars, and so you have to import basically virtual pieces of paper from the United States that our central bank gets to create, and in return you export to the United States real goods and services based on whatever your economy specializes in. And so for the financial class in the United States and for the American consumer, that's an incredibly good deal, right? We get to, invent assets, export them, and then get real stuff back. Now, that is very bad for the American manufacturing base because it makes the dollar strong, and it makes, for the same reason we were talking about, people in Vietnam can't afford our goods and services because the dollar is strong, because the American, worker demands a higher salary. It makes us really hard for us to make exportable goods in the United States. And so that's it's called Triffin's Dilemma, that, if you have the world reserve currency, there's going to be a trade-off between some of your domestic objectives, especially around manufacturing, and then the economic benefit of being able to hold the world reserve currency. So the importance of the 10-year, I think, needs to be understood in, that uncertainty of which path are we going on? Are we going for the Mar-a-Lago Accords? Are we going for the sort of total trade reset? It's especially important if we're going in the sort of more modest Mar-a-Lago Accord world. And I think the only thing to say now is look, as Matt said, it's going the wrong way. It would be one thing, the 10-year is such an important, deep and liquid market that small moves in the yield are incredibly powerful in terms of how much debt the United States is going to owe and our ability to refinance that debt. And so you can make it, an intellectual argument whether you'd see that as 3D chess on sort of one side of politics, or if you're on the left, you call that sane washing. That plan only works if we can lower yields. And right now yields are moving the wrong direction for that plan. And you're starting to see, macro folks say we may actually get the Fed raise rates, which I find a little bit hard to believe, but who knows? But the importance of the 10-year specifically in all of this is whether we'd be able to pull off this sort of Besant, master plan version.
Yeah, and just to put a number on that, about 1%, about 1 basis point move in the 10-year equates to about an extra $1 billion in interest costs for the U.S. government, just as a rough back of the napkin. And one other point of comparison, Trump often talks to people about how he wants to be like President McKinley. And he's read McKinley's biography, the sort of 2 books that Trump was reading, in preparation to become president. This most recent election was the biography of McKinley and a biography of Teddy Roosevelt. And so the only issue is that McKinley, which, they harken back in terms of this trade policy where you could finance the entire government based off of tariffs, essentially, was that primary government expenditure as a percentage of GDP in 1900, when McKinley was president, was about 2 to 3% of GDP. Now it's like 35% of GDP. So just the scale of the federal government as a percentage of the economy is like 10 times the size as it was in the era that this administration is sort of harkening back to. So like fundamentally, right, this sort of, that dog isn't going to hunt. And this is, I think, what we're seeing, right, is like a reckoning with just the scale, the structural shifts that have taken place in the size of the federal government, and then the sort of embeddedness of these debts in our balance sheet. So not great.
Yeah, and the question I have here is like, do you think that the Trump admin sort of made a critical error in coming out very hawkish and then sort of having some internal conflict here about, how exactly this is going to play out? Or was that kind of the plan all along?
I mean, clearly like a 15% drop in the S&P is like, can't be your plan, right? So like that was obviously a policy mistake. Whether that will be viewed in history as just a blip, right? Like you kind of have to wait, right? You have to see. Like I wouldn't judge policy success or failure off of like a 3 or 4 day market move, right? Ultimately, tariffs are about changing structural capital flows and business decisions to reorient the global economy. So I think there is no painless way that will happen, though, right? I think that is like the critical thing. And I think other commentators, like Roman, have talked about how the sequence matters, the orders of operation matter. And you have to recognize these critical constraints, right? Which is the government is running basically 6 to 7% of GDP peacetime fiscal deficits. And so if you want to bring down government spending, right, that's mechanically going to bring down growth because we live in an economy that's essentially been floated by fiscal printing. And so you have to accept, certain hard choices, right? You either want to bring the size of the government down, which is going to affect growth, or you want to rewire the global trade system, which is going to create extra trade frictions. If you try to do both at the same time, you risk crashing the global economy, right? Because you're basically reducing the amount of like fiscal stimulus coming in at the same time that you're increasing business uncertainty and capital investment and consumer confidence. If you do that all at the same time, you risk essentially a quarter over quarter crash in growth. And that has very negative reflexivity, right, in terms of people's expectations of future growth, as well as expectations of future government deficits, because government deficits tend to increase in a recession. And the historical pattern has been deficits increase quite dramatically each recession, to the point where the government could be running 13, 15% of GDP deficits in a recession. And that, you could get to a situation where the US government bond market trades more like an emerging market, where interest rates go up in a recession because we have to print so much debt to finance that sort of countercyclical macro shift in a recession, that there's not enough natural buyers for that debt. And we essentially have to either cap yields with more printing, in which case the dollar is going to crash out, Bitcoin's going to run, or you accept essentially the EMification of your economy, which we won't. I think they're out, right? The one out that a government like the United States has is we still have dominant military power in a lot of places around the world. We have a lot of allies that exist under our security umbrella. And I think the strategy now essentially is to make that more explicit, right? To sort of more explicitly coerce our allies and partners and other folks around the world to essentially help fund our deficits, right? So that's the Japanese, the Taiwanese, maybe even the Europeans, the Middle East, to essentially do a series of these sorts of swaps where they help term out our debt. Maybe they even buy century bonds. I'm aware, for example, that that's already been brought up to the Japanese. They've already been told that we would like them to purchase century bonds. And you can use things like swap lines as a way of funding that, essentially as a form of what I would call sort of geopolitical backdoor QE, right? So QE is when the Fed purchased bonds in the open market to help keep yields down, to put liquidity into the banking system after the great financial crisis. Mechanically, it's been a lot of debate about whether it's money printing, et cetera, like, but the basic function is there's like a government or a government adjacent buyer of bonds that helps keep yields controlled, right? So if we do run into the situation where yields keep rising, right, they're going to have to find unconventional ways of keeping the basic system running, right, and keeping the defense umbrella that is the security zone that underpins global trade in the post-war environment, keeps U.S. on top, but also has these pathologies that Zack talked about in terms of the dollar Dutch disease. You're going to have to get your friends and allies to kind of pony up. But they might not have the spare cash, and so you might have to lend it to them. And so I'm really looking around the corner here to see what this means for the relationship between the Treasury Department and the Fed, because ultimately the Fed controls those swap lines, the provision essentially of dollar funding to other central banks that could then use that dollar funding to buy U.S. bonds, right? And just mechanically, right, that's not any different than the Fed just buying the bonds themselves, that they're just sort of using essentially a straw man purchaser, right? They're using the Bank of Japan or the ECB or the Bank of England or the Swiss National Bank to purchase our debt with dollar funding instruments like swap lines. So I think that's probably coming down the line, but that will test the Fed's independence, right? That will test the degree to which basically the Fed will take orders from nascent to help them engineer this geopolitical and geoeconomic restructuring. So we're operating kind of in this moment where a lot of different tools are on the table, right, for policymakers to try to engineer the geopolitical shifts that they want to see and the trading shifts they want to see. And markets, I would say the top line takeaway I have is that markets are the second order concern. And so they're likely going to move on the policy front first and see how the markets react and then adapt, right? I think they saw this sort of first move was they maybe went a bit too hard in the paint. They didn't anticipate the degree of this mismatch between what they had communicated and what the market was expecting, and then what they did. And then it was like, oh shit. And then now you've got kind of this recalibration. So maybe they'll learn, maybe the next time around, Besant will be in the driver's seat and they'll be able to kind of do this more forward guidance to the markets, as well as more of the kind of technocratic behind the scenes, work the angles with Japan, work the angles with the Middle East and the Europeans. And, nobody wants to lose trillions of dollars, every day, right? That's just like not going to be a winning coalition. So hopefully they'll recalibrate.
Yeah, I think I agree with all that. One just quick point to make is there's one tool we didn't talk about here. Now, admittedly, it's a tool that has more to do with short-term U.S. debt than long-term U.S. debt, but it is going direct to consumer with dollar assets around the world via stablecoins, right? It's an area we know that there is a huge amount of demand from people that want to hold the dollar as a store of value, and they do that currently with Tether. And I think there is an interesting question whether, if we pass federal stablecoin legislation, if we provide long-term regulatory certainty, whether that will increase proliferation of stablecoins both at home and abroad. And recent interviews that Paolo Arduino from Tether has given, make the interesting point that stablecoins probably look in their design and functionality and what kind of product market fit they're looking for quite different at home than abroad. But whether if you have that long-term regulatory certainty, if that can allow you to hold longer term U.S. debt as reserve, as collateral for these stablecoins, because the stablecoins are less likely to be redeemed at any given time, and you don't need to hold sort of cash equivalents like T-bills.
Yeah, and that's actually a critical point that sometimes gets conflated in a lot of these discussions about weakening the dollar, strengthening the dollars. The dollar is sometimes conflated like as a term. Like, what do you mean when you say the dollar, right? Because I think there's a way you can engineer an outcome here where the dollar as a currency weakens relative to other currencies, right? And weakens even relative to neutral reserve assets like gold and Bitcoin. But the dollar network is strengthened from the perspective of sort of DC policymakers in the sense that sort of the nodes that exist in the dollar system, right? That the legacy version of which is essentially the network of hierarchical correspondent banking relationships across the world, that if you want to do a dollar payment or trade finance, it goes through these, offshore dollar balance sheets. And the fact that those are, mostly dollar denominated, and most of the trade and trade finance goes through those dollar denominated balance sheets, is a sort of a network power for the United States. And so stablecoins are essentially a variation of that, but on crypto rails, where essentially these dollar denominated crypto balance sheets are now proliferating around the world, and they exist in these different offshore nodes. And so from the perspective of the US government, making sure that that sort of crypto dollar network remains strong, you can have a policy objective that is dollar network strong, cross currency dollar pair weak, right? And I think sometimes people conflate those two things. And they also conflate that with this idea that Moran has put out there of they want to sort of reduce the reserve demand for the dollar that creates this sort of artificial currency strength, right? And so, but they want to do that without the yields on treasuries going up, right? Seems a bit of an inconsistency, right? How do you want less demand for US debt, but you don't want that to mean that the price of the debt, right, goes down? Where usually your demand goes down for an asset, the price goes down. And this is where you have to sort of engineer demand in a way that allows you to sort of impose financial repression. So you don't pay a market price, right? So you force allies to essentially pay essentially a discount or essentially pay a premium, or you get a discount by selling them that debt, right? That's sort of the idea of century bonds, is that you force the Japanese to buy century bonds. They're willing to essentially buy those, maybe with some dollar funding on the back end, at a fixed rate, right? With a coupon that's, say, below what the market clearing rate would be. And so the US government essentially gets a subsidy from that. I'd say it's 3.5% on the 30 year instead of 4.5%. And that adds up, and it helps you term out your debt. And so you kind of have to force demand for treasuries into these balance sheets, whether it's foreign sovereign balance sheets, or in this case, crypto Eurodollar balance sheets, where, again, like the dollar stablecoin network is a means of financial repression to a certain extent, right? Most dollar stablecoins don't pay interest. I think even the legislation bans interest paying stablecoins. And so that's a certain amount of seigniorage that's being captured somewhere. Right now, it's being captured by Tether, and that's why they're printing $13 billion in profit every year. And the government's like, we want a piece of that action, right? We want a piece of that seigniorage. So I think the high-level political negotiation over stablecoin policy ultimately redounds like, who's going to be able to capture that seigniorage, right? And is it going to be the US government? Is it going to be sort of a small set of firms that have a moat put around them? Is it going to be the legacy banking system? Is it going to be narrow banks that get approved charters? This is why, this actually a new version of an old debate goes back to like Regulation Q in the 50s, which is how the Eurodollar system got started. Is there was sort of regulatory arbitrage between the onshore and the offshore sort of dollar funding markets, and that basically spawned demand for dollar IOUs essentially in the offshore market. And the sort of emergence of stablecoins is like just a 21st century version of that. But it's increasingly now moving from, when it's $100 billion asset class, it's interesting, but it's not sort of extremely geopolitically relevant. But I think all these policymakers are looking at the trajectory of stablecoins and see a very clear path to those being $1 trillion balance sheets, maybe even multiple trillions of dollars of balance sheets, in which case they do have a strategic effect. That's a lot of balance sheet capacity to absorb a lot of treasuries. I think right now the treasury total stablecoins absorb about 2.5% of all the T-bills. Doesn't seem that a lot, but if you 10x, right, the stablecoin market, that's 25% of the short end. Is basically just one sort of market sort of participant. And the government wants to be able to roll lots of debt. Has about $7.5 trillion it needs to roll in the next 3 years. A lot of it's short, coming in the next 12 months. And historically, the government has been forced, through activist treasury issuance to issue mostly on the front end, so they can keep rolling. But when interest rates are high on the short end, that's a very expensive thing to do. So this is where, again, like the technical plumbing, the stablecoin policy, and then kind of these macro and geopolitical sort of structural drivers are all kind of converging now. And it's the reason why these policy questions are quite relevant for folks at the top.
Yeah, and I would add one more policy tool, which might sort of directly have the impact that Matt's talking about here, of without creating more demand for dollar and dollar assets abroad, could conceivably compress yields, which is the other sort of Trump policy idea of the U.S. sovereign wealth fund. Right? If you're thinking about, okay, how much is a long dated bond worth? One thing that's relevant is what do you think interest rates are going to be going forward? Because that's, you don't want to hold a bond with the lower interest rate. But the other thing is, what is the value of the dollar long term, right? What's the actual value of the underlying asset? And then part of that equation of what's the value of the underlying asset is essentially how much money printing is there going to be over the long term. And something that could create money printing is having to inflate away our debt. And so if the United States government takes assets that it owns or can acquire, right? So examples might be Fannie and Freddie. It might be monetizing some of the mineral rights in publicly held land. And it sort of brings that all within the ambit of the Treasury. Then there are other options like revaluing gold, like adding Bitcoin to the balance sheet. Now there is collateral that the Treasury could use ultimately to back up its debts, to finance its debts, other than just tax receipts. That could eliminate some of the need that you would otherwise have to inflate away the debt. And so that's an area where you might theoretically, if you do it well and you do it carefully, you could compress yields without just juicing demand for dollar or the price of the dollar. It's really much more about the Treasury's balance sheet.
Yeah, I guess one other point that come to mind is that we're having a bit of like a debate, but it's not really an overt debate about what GDP is for and like why do we have like that as a measure, right? I think, and like a critical like component of GDP essentially is just like the overall size of the economy, which in a credit-based economy is the amount of debt that gets created. And then we find ourselves in this position where we have to do a lot of these expensive geopolitical and political tricks to try to keep the debt cost serviceable. And we have this political commitment to make sure that GDP keeps growing, right? But it's like we live in a competitive world, in a world where there's obligations in democracy to your citizens. And so you have to ask questions not just about like, is your debt to GDP ratio sustainable, but like, is the actual component of the GDP doing what you think it should be doing? Is it leading to a more healthy and harmonious society that provides flourishing and economic opportunities to all its participants? And does it create an industrial capacity that allows you to be secure and provides security to other parts of the world? That's kind of like first principles, like what GDP is for. And sometimes you get like, we sort of have lost track of that. And we just think GDP is just the number that has to go up, right? But it's like the quality of the GDP, like what's the factors that are going into it in terms of human productivity and overall economic output that is leading to these like social and geopolitical objectives. And I think that's the debate you need to be having, right? Like, and sometimes that's difficult because that's imposes sometimes wealth transfers or implicit economic shifts from certain segments of the society that have benefited from a certain model of GDP, which is like finance, insurance, and real estate, to models of the economy where it's actually more about manufacturing output and more equal distribution of wealth or industrial defense capacity. And so you had sometimes these technocratic debates that are really just obscuring what is ultimately like a political debate, a political fight about what is GDP for. So when the government makes these hard decisions, it's always like someone's going to pay, right? Someone's going to have to take some losses. Is it going to be the bond market that's going to lose? Is it going to be the average saver? Is it going to be foreigners? Is it going to be foreign allies, foreign rivals? And so I think you're seeing like, as you go through these shifts, these negotiations are really about who's going to who's going to absorb these losses. Is it equity market, bond market, hard asset holders, soft asset holders, foreigners, domestic participants? So this is a big bargaining position. So all these market moves are reflecting everyone's view of like who's going to actually end up eating these losses, who has the power to avoid eating those losses. And yeah, I think that's basically going to be the dominant theme.
Yeah, and not to lose sight of the piece of this, which is how much GDP drives the conversation. There's some name for this I've forgotten, but the idea is when there is a variable that you can easily measure, that starts to completely overwhelm incentives. I remember, I used to work in the federal courts, and this was like a big issue in, certain types of criminal prosecutions, like in drug cases. When there was a number, there's a weight, there's a guy who's been, selling crack on the street corner, and you add up all the crack, that gets to a big number, and we tend to overweight that in sentencing compared to other factors. The same is true of GDP. If GDP is, treated one-to-one with economic, prosperity and growth, you're going to have things that goose GDP, and you're going to have policy that gooses GDP. And this is, a very Keynesian mindset about things, right? We need velocity of money. We need stuff built. It doesn't really matter if that stuff is useful or productive. And so, look, one of the best case scenarios to come out of all of this sort of economic uncertainty and shaking things up might be to think carefully about what are the metrics we want to guide us, right? What is the end goal we're trying to get here, rather than what is, most easily measured and, looks best in a chyron on cable news. I think it long due to sort of rehab that conversation.
Yeah. Okay. Reading between the lines here, and I heard the recession word earlier. It seems like that's kind of the thing that markets are fearing right now. How do we see that playing out? And I do also want to dig into the Bitcoin market here. Is it as simple to say Bitcoin is a risk-on asset and that's why we're at the price we're at? Or is there something kind of more significant going on?
I'm sure both Zach and I have takes on this. There's slightly different questions, right? Like the recession is just a macro question. You can look at certain indicators, leading indicators. At the Atlanta GDP Fed now has like a real-time tracker. It's shown a pretty steep fall off. One interesting note there is that they had to correct that for gold imports, because the scale of the amount of gold the U.S. was importing, maybe it was the U.S. government, maybe not, was so high, basically contributed to a calculation of GDP that was like dramatically lower. So you had essentially a negative 4% real-time estimate. They now introduced a correction for the gold imports that brought it to like negative 2.5%. I think most sort of macro consensus is now leading to like more likely than not we'll have a recession, meaning which technically I think is just 2 quarters of negative GDP growth as measured by what's the government agency that calculates that? I forget. But like there's a particular government agency that basically makes that proclamation. Usually it's done in retrospect, right? So usually you find out you've been in a recession like at least a quarter or two later. And so you're in this environment now where that's starting to get priced in to a certain extent. I think that it matters less to me than what's going to happen after that, right? Like, because I think it's clear to me that politically, right, this administration needs asset prices to be higher in 2026 and 2025, right? They need economic growth to be higher in 2026 and 2025. They're going to be going to the midterm elections. So a lot is riding on like what sort of policy instruments can they pull between now and then. And I think it was clear that they understood that they wanted to do any sort of big change. They had to do it sooner rather than later because they knew it was going to be somewhat disruptive. There was going to be some amount of pain. And so better to have that pain happen well in advance of any election so that you give yourself time to goose things back up, right? So my whole expectation, sort of my model of the Trump, first 2 years was like hit the skids, do something pretty disruptive, unclear how disruptive or how well coordinated or how well, telegraphed it was going to be, but it was going to be like a bit of like a slowdown, a bit of a chaos. And then they would do the run things back turbo, into 2026. That was sort of like my heuristic for how the political economy would just dictate market outcomes here. So it remains to be seen, right? Right now we're in that, okay, they did their thing. Like they're ripping Band-Aids off here. It's painful. Everyone's like, a bit uncertain. And so the next phase of this, maybe not immediately, but I would expect over the course of the summer as they try to get some of these big geopolitical and trade deals settled, which I think they really are going to be focusing on the next two months or so. They're meeting in Riyadh in middle of May. There's gonna be a lot of stuff with Japan happening now this month. And then after that, I think there's folks expecting something like a Mar-a-Lago Accord, or at least a meeting at Mar-a-Lago by the end of June, so that they can go into the summer, and have the details being worked out, and then maybe there's a China component to that happens later in the year, and that if Trump can go into 2026 and say, we've it was a bumpy year, but I got these deals done, I got these favorable trade concessions, and I think their hope is that the endogenous trajectory for economic productivity, especially AI, right, and the capital expenditure build out, and their hope that this will sort of and maybe their deregulation push, and plus whatever the tax cuts they can get agreed upon, will provide enough kind of productivity improvements as well as fiscal impulse to run things back turbo in 2026, and then they can hold the line in the Senate and the House. That's a lot of things that kind of have to go right. But I think that's a sequence that we could see.
Yeah, for me, I think the questions both about recession and Bitcoin price action are downstream of the sort of initial question I posed about which timeline are we in? Are we in the Mar-a-Lago Accord timeline? Or are we in the, we're going to try as hard as we can to reverse trade deficit timeline? If we're in the Mar-a-Lago Accord timeline, I think we still may very well get a recession. The question is, how long does it last before we reach a deal? I mean, we saw some evidence yesterday when there was a fake news headline tweeted about a 90-day pause. The markets, quickly ran it back turbo and until that was shown to be false. Now, the things, either a deal could be announced and that would maybe turn markets around in general and maybe prevent a recession to some extent, depending on what the contours of the deal are. Or something could break that would push things in the direction of reaching a deal, even if that's not the administration's current plan. My best guess is that looks like people actually losing jobs, right? And you'd see real estate prices going down, and you'd see companies meaningfully shifting their sort of forward guidance about what they think earnings are going to be, depending on sort of recessionary conditions. And so it could either be an intentional Mar-a-Lago Accord outcome, or it could be they could have their hands forced by the market, and then we'll have a quick reverse in policy, and we might have that sort of V-shaped recovery. Now, in that world, if we're able to get yields down, I think that maybe puts us on a slower, if we're turning to the Bitcoin side of things, it maybe puts us on a slower, like long-term adoption cycle for Bitcoin, because we can keep the fiat Ponzi going a bit longer if we can term out our debt and not face the sort of real financing crisis that would cause us to do a ton of money printing that sort of Matt was talking about at the beginning. But then in the short term, that's probably great for Bitcoin price action because we'll have more liquidity in the system, and then there will be sort of less uncertainty, and then risk assets like Bitcoin will probably go up. Now, if we're in the longer term, sort of we're going hard in the paint on reversing the trade deficits, I think then we likely are in for just a meaningful long-term recession or maybe depression. It's just not going to be a quick or easy or painless process to reshore manufacturing broadly. Those aren't sort of the chops or skills we have, and it's going to be years before factories could be spun up. Automation is definitely moving fast, but is it here fast enough? China, from all accounts I've heard, is way ahead of us on robots and automation right now. And so this will take a while, and this will meaningfully affect companies' earnings, and it'll meaningfully affect the price of the supply chain. And so probably, then the recession is more serious and longer lasting until if and when we're able to sort of reestablish sort of a less globalized economy. Probably short term, that could be bad for Bitcoin, which trades like a risk-on asset. However, then if you look down the road a little bit, like, okay, if we're now, going to create a bigger debt problem for the United States, if we are going to sort of run back some of Triffin's dilemma, and we're going to undermine the status of the dollar or the Treasury as world reserve assets, then you could actually see Bitcoin playing a really meaningfully more different role on a quicker timeline than otherwise. So I think these questions are sort of intertwined. And for recession, the question is just, are we going to reach a deal or not? And is the market going to go down swiftly enough to force sort of a policy pivot versus we're in this for the long haul? And then for Bitcoin, I think this sort of short-term and long-term trade-offs are reversed in each case. If this ends up being a quicker sort of deal-based or pivot-based shift in the markets, that's probably good for Bitcoin short term and means maybe slower adoption long term. However, if we go into the sort of weirder and darker path, while that might mean we get a bigger dip now, that might actually hasten sort of more serious structural Bitcoin adoption down the road. And then one last thing to say on Bitcoin is there is the X factor here of sort of direct United States policy with regard to Bitcoin. The government, I think, was supposed to have received a report yesterday at the latest of what the government's current Bitcoin holdings are. There are reports due from the Treasury and Commerce departments about the United States government's plans to acquire more Bitcoin for a strategic reserve. We could hear announcements from other countries that would spur U.S. adoption of Bitcoin in a different way. And you could imagine, as Matt has done at length in pieces he's written for BPI, of how Bitcoin could specifically fit into some of these Mar-a-Lago Accord type global reorderings that would, I think significantly speed up the Bitcoin adoption timeline beyond the sort of secular economic trends we've been talking about this far.
Yeah, the one model I have just thinking about this is we're a highly leveraged, financialized economy dominated by multinational conglomerates, right? Like that's sort of, if you had to like describe what it is, right? Like what modern capitalism is, essentially it's that, right? That's the reason why you have the Mag 7 dominate the indices, is like these $1 trillion conglomerates that are fundamentally like international constructions, right? They're like US companies, but they book all their taxes in Ireland, all their manufacturing is in Asia, right? Their headquarters and design is in San Francisco, and their equities trade in New York, right? And so there are these, you think about like what the modern conglomerate is, and that's kind of their architecture, right? And that architecture is sort of what is being attacked in some ways by these policies, right? They basically say, we don't want that architecture to dominate our economy anymore. We want to bring some of that manufacturing home. We don't want you to book those profits overseas. We want you to essentially build in America, keep that capital in America, pay taxes in America. And so you're kind of going squarely at like the core of the system, right? And that's expensive, right? I think it's what people realize. Oh, wait, they want basically these conglomerates this is going back to the two books that Trump was reading, not just McKinley in terms of financing the government off of tariffs, but Roosevelt, which was breaking up the monopolies. And the monopolies of his day were the oil barons. The monopolies that the MAGA constituencies dominate the U.S. political economy are these tech giants. And you can see like the tech right coalition that formed to bring Trump into office was kind of this loose confederation of some sort of maybe defectors from kind of the liberal consensus in the last few years, right? Elon and crew that sit atop these tech conglomerates. And so to a certain extent, there's this tension here between kind of the trade geoeconomic reordering objectives that someone like the Pete Navarro types, the Besson types, the Lutnick types have in the White House, and the faction that kind of came in relatively new to the MAGA coalition, sort of the Elon types. And I think that coalition is not happy with what we've seen in the past week, right? Like, because their equity prices go down 30% in a week, and also this global supply chain kind of diversification conglomerate strategy is sort of threatened, right? So that is, for me, the really fascinating dynamic that's going to play out. It's like inside the sort of the Trump coalition. It's not like a left versus right fight. It's like an internal coalitional fight. I think Bitcoin is actually like emerging into that coalition, kind of this in a very kind of non-obvious way, right? Because I think both sides kind of see it as a positive thing to align with, but it's not obviously aligned with any one particular side. So it's kind of in no man's land, right? And so it doesn't necessarily have like a natural champion inside that coalition to be like, Bitcoin is my key thing, right? It sort of floats out there as wouldn't it be interesting as like an auxiliary asymmetric play, with gold and say this, Bretton Woods 2 type arrangement that Besson has. But on the other hand, you have, and that's on that side of the fence, and the Bannon people are very pro Bitcoin. But then you also have kind of the folks, obviously David Sachs is the crypto czar, and you have a lot of folks in Silicon Valley that are very pro Bitcoin, that are very much, behind it as kind of this, future of money in the digital age idea. So I think I actually think Bitcoin is one of the few things that can span kind of that intra-elite kind of coalition fight. But because it's kind of not obvious to any particular element of that coalition, it's not going to be the one thing that they sort of pick up as their main thing. So I think it can kind of float in kind of the ether there, and that's we're sort of waiting on these sort of catalytic moments related to the SBR and the Middle East and Asia, sort of geopolitically, to kind of push it to a different level, right? And that's why I'm paying a lot of attention to these moves that are very much kind of sub rosa and kind of positioning style moves, where Trump, made a dramatic first, ante when he described Bitcoin as a strategic asset. Talked about it as digital gold in his executive order, committed the government never to sell it as long as he's in office, established an executive-based SBR. His officials have given, kind of subtle but explicit endorsement of codifying the SBR in law, doing it without adding to the budget deficit. And governments around the world are picking up on that. And, it's like icebergs, right? There's a lot happening underneath the surface, and it's also like a cruise ship, right? Like you start spinning the wheel in the captain's chair, but it takes a while for the ship of the state and states to actually move direction. And it's I think that has started. It's just somewhat small initial moves, but once governments decide to shift their strategic view of an asset like Bitcoin, that tends to be pretty sticky, and it tends to have strategic effects over time. It doesn't happen overnight. But I think you're already hearing, folks like Larry Fink talk about his conversations with sovereign wealth funds allocating 2 to 5%. I know those conversations are still very active as we speak, right? Folks in Qatar, folks in Saudi Arabia, folks in the Emirates, they've picked up starter positions, and I think they're building on those positions. But these are complicated bureaucratic machines, and they don't move quickly. But they tend to move in size over time. And so we could be seeing a shift, but that shift isn't what we see in the market pricing dynamic, right? Where Bitcoin is, a liquidity barometer, and there's a lot of algorithmic traders that dominate spot price movements on sort of a hour-to-hour basis. And so that tends to be highly correlated to, overall risk on animal spirits. So I don't expect that. I know everyone was obsessed with decoupling on Friday because NASDAQ was down like 6%, Bitcoin was up 2%. My hypothesis for that was just there was forced selling margin calls on hedge funds, and they had to dump all their liquid assets. And I just think most hedge funds didn't hold Bitcoin. So they were forced to sell Apple stock and Tesla stock and, other related equities. And so those just took a massive dive, and they didn't have any Bitcoin on their balance sheets to sell. So Bitcoin was just kind of there. And then over the weekend, I think people had the sort of Monday preview panic. But anyways, I think we're in this dynamic where I'd say 90% of the price moves of Bitcoin are just risk on. I do think, though, that I have to look at the exact chart, but Bitcoin has held up relatively better than NASDAQ, if you say measure it from the election, or measure it from January 20th, or measure it from, whatever date you want to pick. So in that sense, there clearly is like a kind of decoupling. Right. There's something else kind of holding up Bitcoin that is this view of its future potential strategic reserve function. It's very nascent right now. Right. So of course it still gets dragged lower because most of its pricing is dictated by overall risk on appetite. But that fact that divergence is still there, that's not down more than NASDAQ, like that to me is a market signal that there's some element of Bitcoin that's pricing in this emerging sovereign reserve asset potential, right?
Yeah,
that's what I would expect.
I think a different way I'd phrase that is that there is a secular trend in Bitcoin only since, at the very earliest, you could say since like 2021-ish or 2020, but really in a bigger way since the beginning of 2024, where Bitcoin is going from being an illegitimate asset to a legitimate asset, right?
Mm-hmm.
For a real macro asset that you can say, if you're a government or a company that you're holding, that's taken seriously, that doesn't come with career risk. And, it's interesting, like at BPI, we oftentimes are having some of these conversations in the sort of captain's cabin of the large cruise ship. And it's, very easy to lose sight of the bigger picture of like, where is the ship itself moving? But things like BlackRock recommending a small allocation to Bitcoin as part of their model portfolio for everyone. Things like, Besant saying in a recent interview with Tucker Carlson that, lots of things are a store of value. Gold is a store of value. Bitcoin is becoming a store of value. This is actually evidence that the actual wake of the ship is turning. And, look, it's always a fool's errand to try and predict a Bitcoin price over the short to medium term, especially from macro people, right? I mean, like, our whole industry has a enormous glut of macro think boys saying that they know what's going to happen in the next couple of months, and it's just always wrong in a comical way. But if you zoom out enough, you really can see where this is heading, either slowly over the long term, or if we hit an inflection point where, as Matt said, Bitcoin is a puzzle piece that fits nicely into a lot of parts of the sort of administration's agenda right now. And maybe, a lot of these players don't realize that explicitly. But if that were to click at some point, then you might get the, then suddenly moment that the Bitcoiners like to talk about. And you can have these massive movements very quickly. And so with Bitcoin, it's just always good to take the long view on price action. The fundamentals of Bitcoin are not only unchanged, but they are stronger than they've ever been. And if anything, made stronger by some of this geopolitical economic reordering. Any sort of price downward movement now, I would say, is a gift if you have a long-term view on Bitcoin. And that's what I'd focus on rather than what is Bitcoin going to do this cycle or over the next couple of months. Just zoom out.
Great. All right. We might need to call this the Bitcoin Policy 2 hour for next time, because I feel like there's still a lot we could have covered, but gonna call it here. Thank you both for joining, and we'll see you next week.
Awesome. Stay tuned.
Looking forward to it.